Well, good afternoon. Happy Friday, September 16th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. Boy, one day I am going to record a video for this Friday afternoon series, and I'm going to have good news. But that day is not today. And the reason for that is that we got the CPI, the Consumer Price Index numbers here this past week. Boy, we were all hopeful that that Consumer Price Index number would continue to show that maybe the peak of inflation is behind us and inflation is moderating, things are getting better. Unfortunately, it did exactly the opposite. It gave all indications that inflation is not under control. Inflation is not trending in the correct direction. Inflation came in double expectations when you get to the core number. And when we talk about Consumer Price Index, there's a lot of variables in there, but let's focus on the core CPI, which strips out volatile items like food and energy. Of course, energy being so volatile because of the conflict in the Ukraine. So if we get food and energy out of there, we're just talking about core prices outside of food and energy. The month-over-month reading was 0.6% increase over last month. We were projecting a 0.3% increase. That was not welcome news for the stock market. That was not welcome news for the bond market. You've seen a huge sell-off in equities, but you've also seen an issue with bonds, and mortgages are basically just long-term bonds. So this problem for bonds is a problem for mortgage interest rates. So now on the table for next week is the potential for the Fed to say, hey, we are going to hike the Fed funds rate, not just 3/4 of a point, which by the way is a massive hike. Now potentially on the table, futures traders are pricing in a 25% chance that the Fed is going to hike the Fed funds rate by a full percentage point. That is something that hasn't been done since the 1980s. We haven't seen a Fed hike the Fed funds rate in one fell swoop by 1 percentage point since that time period. Really, this is just all around trying to get inflation under control. The reality of it is, whether you want to blame the Fed for the inflation that we have or you want to blame the government stimulus, the Fed was late getting a start on inflation, and now they're playing catch up. So the longer this delays, the longer they forestall the ultimate pain of getting the Fed funds rate upwards of 4.5%, the longer inflation is going to be a problem. This is just something that has to be done. We have to take our medicine now. I'll flip the screen around here and show you exactly what I'm talking about. Mortgage-backed securities over the past 5 business days, one of the worst weeks that we've seen, unfortunately. This is the big day here. This is the day the CPI came out, the Consumer Price Index, but really haven't seen a bounce back, haven't seen that this was an overreaction. This just continues to worsen, and now we find ourselves across several note rates being upwards of a 0.5 percentage point higher in mortgage interest rates this Friday than we were last Friday. That's a tremendous amount of loss of affordability for the American consumer, for the American home buyer. It's just one of those unfortunate realities about where we are as a country and how bad inflation has gotten. I'll flip the screen around and show you one more thing here. So you'll see the Fed rate hike, the 2-year Treasury now topping 3.9%. Now, one of the sort of layman indicators of a pending recession is when the 2-year Treasury is higher than the 10-year Treasury. So if you can give your money to the government for 2 years and earn upwards of 3.9%, but you can give your money to the government for 10 years and earn 3.4%, which one are you going to do, right? You'd obviously pick a shorter time period where you can earn more than a longer time period where you would earn less. And this yield curve inversion is a pretty solid indicator, especially when you see this kind of disparity, a pretty solid indicator that we are headed for a recession in this country. Lots of sentiment out there that the Fed should go ahead and do it, raise the Fed funds rate 1 full percentage point, 100 basis points here in their meeting next Tuesday and Wednesday. The policy statement coming 2 p.m. Eastern time on Wednesday. Really what traders are saying is there's a 75% chance of a 3/4 rate hike, a 25% chance of a 100 basis point rate hike. I think it wouldn't surprise me at all if those numbers get closer to 50-50 as we approach Wednesday afternoon at 2 p.m. We'll have to wait and see how it plays out. But the long and the short of it, folks, there's no way to spin this as good news. No matter what side of the fence you are, if you're a stock trader, if you're a bond trader, no matter what you're looking at, it's been a rough week in terms of this inflation data, and it's going to continue to take its toll until we see sustained, pronounced evidence that inflation is moderating. And the fastest way that we can do that is to go ahead and take our medicine and raise the Fed funds rate and deal with this inflation problem that's plaguing the United States. If I can be of any service to you in the interim, don't hesitate to reach out, mark.milam@highlandmtg.com. Have a good weekend.